What is the S&P 500 stock market index? When it comes to the major US stock indexes, none is more highly regarded as a barometer of the overall stock market's performance and an indicator of how large corporations are performing than the S&P 500 index. In this episode, you will learn what the S&P 500 index is, how it works, how you can invest in it, and why doing so could be a smart move for you. But before we dive deeper, let's look at what the S&P 500 index is. The S&P 500 is a stock market index that tracks the stocks of 500 large-cap US companies. It represents the stock market's performance by reporting the risk and returns of the biggest companies. Investors use it as the benchmark of the overall market, to which all other investments are compared. The S&P 500 index is weighted by market capitalization, share prices times number of shares outstanding, which means that a company's valuation determines how much influence it has over the index's performance. Each listed company doesn't simply represent 1/500th of the index. Massive companies such as Apple and Amazon have a greater impact on the S&P 500 index than relatively smaller companies like Macy's and Harley-Davidson. One key point to know is that although these are 500 large companies, there's a wide range. Several of the largest companies in the index have market caps in excess of $1 trillion, and they're more than 200 times larger than the smallest S&P 500 components, which have market caps between $6 billion and $7 billion. The value of the S&P 500 index fluctuates continuously throughout the trading day, based on the weighted performance market data of its underlying components. Why use the S&P 500? You may be wondering why the S&P 500 is considered so useful as a market and economic indicator. Because the S&P 500 consists of a broad basket of stocks without too many small or obscure companies. It contains the companies the most widely owned by individual investors. The 500 companies account for roughly 80% of the overall value of the stock market in the US. Now let's see what factors that companies must meet before they're listed on the S&P 500. To be eligible for the index, companies must meet certain criteria, including having a market capitalization, which refers to the total value of the company's outstanding shares, of at least $8.2 billion, being based in the US, being structured as a corporation and offering common stock, being listed on an eligible US exchange. Real estate investment trusts, known as REITs, are eligible for inclusion. Having positive as-reported earnings over the most recent quarter, in addition to over the 4 most recent quarters added together. Thanks to this criteria, only the country's largest, most stable corporations can be included in the S&P 500. The list is reviewed and updated quarterly. The S&P 500 index is composed of 505 stocks issued by 500 different companies. There's a difference in numbers here because a few S&P 500 component companies issue more than one class of stock. For example, Alphabet Class C and Alphabet Class A stock are both included in the S&P 500 index. Obviously, it won't be practical to list all of the S&P 500 companies in this video, but because the S&P 500 is weighted by market cap, its performance is mostly driven by the performances of the stocks of the largest companies. With that in mind, here's a look at the 10 largest companies of the S&P 500 index as of March 2021. This list and its sequence can, and probably will, change over time. Apple, Microsoft, Amazon, Facebook, Alphabet Class A, Alphabet Class C, Berkshire Hathaway Class B, Tesla, JP Morgan Chase, Johnson & Johnson. How can you invest in the S&P 500 index? You may invest in the S&P 500 index by purchasing shares of a mutual fund or exchange-traded fund (ETF) that passively tracks the index. These investment vehicles own all the stocks in the S&P 500 index in proportional weights. The Vanguard S&P 500 ETF, which trades just like a stock, and the Vanguard 500 Index Fund Admiral Shares Mutual Fund are two attractive options. Both have extremely low fees and deliver over time virtually identical performances to the S&P 500 index. In addition, you can buy S&P 500 futures, which trade on the Chicago Mercantile Exchange. These are essentially buy or sell options that enable hedging or speculating on the index's future value. If you're still unsure how to invest in the S&P 500 index, make sure you hit that subscribe button and stay tuned for our future episode covering that topic in detail. Now you know how to invest in the S&P 500 index. How does it compare to other indexes? The S&P 500 is one of several leading equity indexes used to measure and understand the performance of the US stock market. Here's how it compares to two other common stock indexes: S&P 500 versus Dow Jones Industrial Average. The Dow Jones Industrial Average, DJIA, also known as the Dow, follows a much smaller number of companies than the S&P 500. The Dow tracks 30 blue-chip US companies judged to be the largest, most stable, and most well-known companies that are leaders in their industries. Unlike the S&P 500, the DJIA is price-weighted, not market cap-weighted. This means a company's percentage weighting in the index is proportional to the price of its shares of stock. Components with higher share prices are given greater weighting in the index. This has a couple of important implications. Smaller Dow components may disproportionately be influential, because weighting is based on stock price. Companies with higher stock prices have more influence on the level of the DJIA than they would in a market cap weighted index, independent of their market cap. A company with less expensive shares but a much greater market cap would play a smaller role in influencing the direction of the Dow. The DJIA may experience more volatility. Because of its price weighting, the Dow can also experience sharper and more frequent highs and lows than the S&P 500. Consider this: company XYZ stock is worth $200. When it drops $1 in value, the DJIA goes down a greater percentage than if a company with cheaper stock lost the same amount. This happens even though $1 is a smaller percentage of $200 than it is of, say, $20. That said, over the long term, the S&P 500 and Dow have seen similar rates of return. From January 1920 to 2020, the DJIA averaged 10.1% annual returns, with dividends reinvested, while the S&P 500 averaged 10.3%. S&P 500 versus Nasdaq. The Nasdaq 100 tracks 100 of the largest and most actively traded non-financial domestic and international securities on the Nasdaq stock market. Like the S&P 500, the Nasdaq uses a market cap weighting formula, though other factors influence stocks' inclusion. To be part of the Nasdaq, stocks must have a minimum daily trading volume of 100,000 shares and have been traded on the Nasdaq for at least 2 years. Unlike the S&P 500 and the Dow, Nasdaq includes some foreign companies and is heavily weighted toward tech companies. Because of that, the Nasdaq is less indicative of the overall US market than it is of its investors' feelings towards the tech industry. Over the last 10 years, the Nasdaq has averaged 42.6% annual returns, while the S&P 500 has averaged 11.2%. Keep in mind though that its high recent returns are in large part due to its heavy tech weighting. Is investing in the S&P 500 right for you? Legendary stock market investor Warren Buffett has famously said that a low-cost S&P 500 index fund is the best investment that most people can make. It's not difficult to see why. Over long periods, the S&P 500 has delivered annualized total gains of 9 to 10%, and you can easily invest in a passive S&P 500 fund for virtually no cost. To be clear, if you have the time, knowledge, and desire to properly research stocks and maintain a portfolio, we feel that it's certainly possible over the long term to achieve superior investment returns relative to the S&P 500. However, not everyone has the time and discipline needed to invest in stocks that way, and newer investors in particular may be better off buying shares in an S&P 500 index fund until they build up their knowledge. In a nutshell, investing in the S&P 500 is a way to get broad exposure to the profitability of American businesses without too much exposure to any individual company's performance. Over time, the S&P 500 can produce strong returns for your portfolio and with minimal effort on your part. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck, and see you in the next episode.